This week was kind of a mixed bag, but overall keeps us on track for lower rates ahead. We got more confirmation that the labor market isn't as strong as it's been made out to be. The government's had to revise job growth over the past year down by nearly 1 million jobs, and that's the biggest revision ever. That means that basically for months the economy has looked stronger on paper than it really was, which, like I've talked about, has unfairly hurt us in the mortgage bond market. And on top of that, jobless claims actually jumped to their highest level in almost 4 years, and that just shows more people are being let go and fewer new jobs are being created. For the first time in years, there's actually now fewer job openings than unemployed people. On the inflation side, wholesale prices, which is what businesses pay, did cool off, but consumer prices kind of ticked up a little bit. And the big issue is still housing. The way that the government measures rent inflation is overstated compared to real-time numbers that we're seeing. Almost a third of CPI comes from what homeowners think they can rent their house out for, which is not exactly an accurate measurement. In reality, new rents are actually flat or even down, which means inflation isn't running as hot as the official numbers have suggested, like I've talked about in previous updates. And that's important because the Fed, is quote-unquote data dependent when they're making decisions to cut. And markets have already, markets are already expecting that Fed rate cut this month. And now there's a kind of growing talk of more cuts later this year. And looking at what the 10-year and mortgage-backed securities have done since Powell basically said they'd be cutting, it's probably already priced in, so people who are waiting on the actual cuts to see rates come down even further might be disappointed. In housing, cancellations are rising, and actually more than 15% of July contracts fell through, which is the highest on record for July. High costs, insurance prices, and just volatility are making buyers nervous, but at the same time, we're also seeing purchase applications rise compared to last year, and refis are jumping up too, which just shows that buyers are starting to come off the sidelines as rates improve. But bottom line is, rates are actually like the best they've been in almost a year, and momentum is finally seeming to shift in our favor. Next week's Fed meeting will be the big one, of course, and we'll get the official rate cut decision along with Powell's press conference. But for buyers, it's worth running numbers now instead of waiting, because when rates do dip, competition heats up, of course, and when we do see the 10-year move lower, it hasn't lasted for longer. You can look over the last 3 years to see for yourself. But I'll see you next Friday for another update. Have a great weekend.